On Monday, Treasury Secretary Scott Bessent stepped onto the global stage and told the world to invest in U.S. assets. By Tuesday, $15 billion had already fled into gold, and by Friday, the U.S. dollar had cratered 9%, its worst slide since the 2008 financial crisis. Think about that for a moment. America, the nation that has long been considered the safest place to park money, is now begging for investment while its own investors are sprinting for the exits. Meanwhile, Apple is swallowing a $900 million tariff bill. The Treasury is borrowing $500 billion just to keep the lights on. And somewhere behind closed doors, the much-touted trade talks with China? They might as well not exist. This isn't a strategic play, it's emergency triage. And now, the shockwaves are spreading worldwide. On May 6, 2025, Bessent addressed a room full of global CEOs at the Millen Institute. His speech sounded less like a policy briefing and more like a performance. "We've uprooted waste, planted investment, and fertilized growth," he said, painting a metaphorical picture of a thriving economy. But behind that flourish of words was a quiet but unmistakable cry for help. The U.S. economy was showing stress, and everyone could feel it. By Bloomberg's reporting, the U.S. dollar had lost 9.2% of its value since April 2nd. Foreign investors were rapidly unloading $36 billion in U.S. treasuries in just 2 weeks. In short, the U.S. wasn't just struggling to attract capital, it was desperately trying to stabilize it. Japan and Germany, two of America's most reliable financial partners, halted new bond purchases, citing currency volatility and tariff uncertainty. And yet Bessent insisted that America remains the center of global finance, a term implying trust and cooperation. But here's the question. When the U.S. is hemorrhaging capital instead of drawing it in, is that trust still real, or just a hopeful illusion? This raises a deeper question. Was Bessent projecting genuine optimism, or was he trying to manage damage before the next crisis hit? The Wall Street Journal highlighted that the dollar's 9% plunge since the April tariff hike has effectively wiped out gains for foreign investors. Meanwhile, U.S. equities are barely keeping pace, with the S&P 500 up only 1.7% year-to-date, less than the current inflation rate. For foreign buyers, it's a math problem with no easy solution. Treasury yields hovering near 4.9% do little to offset losses from a declining dollar, especially when U.S. inflation sits above 3.2% and energy prices have surged 11.4% since March. HSBC's Q2 briefing reports that institutional investors are moving dollar-denominated holdings into Eurozone and Swiss franc assets, seeking safer ground. Bessent's assertion that deep, liquid capital markets provide security is only half the story. Liquidity without confidence can actually accelerate the outflow of funds rather than stop it. And the numbers prove it. Net outflows from U.S. equities hit $11.6 billion in April, according to Bank of America. So when your pitch is built on dollar dominance, and that dollar is visibly losing strength, is the promise real or just rhetorical scaffolding? And if that scaffolding collapses, what's left holding up the entire financial house? Volatility isn't a theory, it's happening in real time. In the week ending May 3rd, the Nasdaq recorded its largest spike in volatility since October 2022. Yet Bessent called U.S. markets anti-fragile, suggesting they thrive under stress. That claim sharply contrasts with Goldman Sachs's latest outlook, which warns of valuation headwinds and projects only a 3% upside for U.S. equities through Q4 2025. The disparity between optimism and reality is striking, and it leaves investors with a difficult question. Who's right, and what's next for the world's largest economy? The Conference Board's Consumer Confidence Index fell to 95.2, the lowest level since June 2020. At the same time, McDonald's reported a 6.4% decline in U.S. same-store sales, marking its worst quarter since the pandemic. Meanwhile, the Atlanta Fed's GDP Now tracker revised Q2 growth down to just 0.6%, following a flat Q1. In an environment like this, Besant's up and to the right mantra starts to sound less like grounded economic insight and more like mythology. And when this mythology meets quarterly earnings season, the disconnect becomes impossible to ignore. But perhaps this isn't optimism at all. It may be a carefully crafted insulation, a way to avoid admitting what happens when consumer spending slows and borrowing spikes. Pause for a moment. When Warren Buffett's famous "Never Bet Against America" line appears in a Treasury speech, it's rarely a sign of underlying strength. In fact, Buffett trimmed his U.S. exposure in Q1 according to SEC filings, cutting his stake in U.S. financials by 12%. And Janet Yellen's warning on May 4th, delivered through the Brookings Institution, was crystal clear: tariffs could push the U.S. 40% closer to recession if critical imports remain disrupted. This isn't speculation. U.S. clean energy companies like Plug Power and Albemarle have already slashed production forecasts due to blocked Chinese mineral imports. Meanwhile, Bloomberg reports that first-quarter capital expenditures across S&P 500 firms fell 9.8%, the steepest decline since 2009. Yet Besant's narrative leans on growth fueled by deregulation, tax cuts, and liquidity injections. But when capital expenditures shrink, consumer spending softens, and the Treasury borrows $514 billion in a single quarter, the big question emerges. What is actually being pitched here? If this is supposed to be the start of a harvest, where exactly is the yield? On May 3, 2025, gold prices soared 1.3% in under a minute, a jump worth over $280 per ounce. This wasn't just a hedge against inflation. It was a clear signal of eroding confidence in fiat currency stability. Bloomberg reports that the spike was driven by institutional orders exceeding $15 billion, triggered by automated sell-offs in U.S. Treasuries and ETF reallocations. The World Gold Council notes that central bank purchases hit a quarterly record of 290 metric tons, with China and India leading the buying spree. Meanwhile, the S&P 500 trades at a forward PE of 21.4, above its 10-year average, while real returns on 10-year treasuries remain negative after adjusting for inflation. This isn't merely about safe haven flows. It's about capital searching for an escape route from a system that looks increasingly over-leveraged. While Besant calls for renewed investor confidence, the market is putting its trust in metal, not monetary policy. But the real warning isn't gold's surge. It's the silent flight of capital from assets the U.S. depends on to stay afloat. And meanwhile, tariffs on Chinese goods now average 135%, with an additional 20% specific surcharge still in effect. Each of these measures is squeezing both corporations and consumers, creating a backdrop where confidence is, well, fragile, and every policy announcement is measured against real-world financial stress. On May 2nd, the White House formally ended the de minimis rule, making all imports under $800 fully taxable. The effects were immediate. The Port of Long Beach reported that import volumes fell 19.2% year-over-year in April, while delivery costs for Chinese goods skyrocketed. One container ship alone, the OCL Violet, faced $420 million in added tariffs on a $560 million cargo. Apple's CFO, Luca Maestri, confirmed during the May 1st earnings call that the company expects a $900 million increase in tariff-related costs this quarter. For domestic businesses, absorbing, or passing on, these costs is no longer sustainable. Importers of solar panels, industrial chemicals, and electronics are reporting 30 to 40% margin compressions, according to a U.S. Chamber of Commerce report. So while Besant reassures global investors with talk of long-term resilience, companies on the ground are being strangled by a policy framework with no operational clarity. And if even America's largest multinationals can't weather these costs, who is left to carry the economy forward? The latest GDP data from the Bureau of Economic Analysis shows first quarter 2025 growth flatlining at 0.3%, with imports collapsing 5.1%, the steepest drop since early 2020. This signals front-loaded consumer demand and disrupted supply chains. Janet Yellen warned on May 4th that these tariffs are pushing the U.S. 40% closer to a technical recession, especially since over 38% of industrial inputs are still sourced from China. EV battery makers, including Rivian and General Motors, are reporting delays in lithium and cobalt supplies, while Plug Power has slashed its 2025 revenue forecast by 18% due to raw material shortages. Bessent's response, deregulation, reshoring, and tax cuts, sounds expansive on paper, but is structurally contradictory. The Treasury is set to borrow $514 billion this quarter, with interest payments projected to exceed $1 trillion by year-end. According to the Congressional Budget Office, fiscal leeway is rapidly evaporating. Meanwhile, consumer confidence continues to slide, now at 95.2 per the Conference Board. So the real question emerges: when the administration's most aggressive economic levers become the triggers of a slowdown, what happens next? On May 5th, the U.S. Treasury auctioned $12 billion in 3- and 10-year notes, but only after raising yields by 38 basis points to attract buyers, a clear sign that global appetite is weakening. Foreign holdings of U.S. debt dropped by $71 billion in April, with China cutting exposure by $23 billion alone. Meanwhile, real yields remain negative across most maturities, and the Federal Reserve has offered no guidance on 2025 rate cuts, citing tariff-driven inflation pressures. The IMF warned last week that the U.S. could face a debt refinancing shock if short-term borrowing continues at this pace, especially with $1.6 trillion in T-bills maturing before quarter 3. While Bessent frames U.S. bonds as a stabilizing anchor, the surge in debt issuance amid policy instability is creating a volatile feedback loop. Capital isn't fleeing just because yields are unattractive. It's questioning whether the underlying math still works. And when safety becomes relative, the only question left is, safe compared to what? As of May 6th, there are no confirmed trade talks with China. Despite Bessent's suggestion that progress is underway, Reuters reports that the only scheduled meeting in Switzerland is a multilateral WTO session, not a bilateral U.S.-China negotiation. Meanwhile, tariffs have effectively created an economic embargo. Chinese exports to the U.S. are down 31% year-over-year, with U.S. firms reporting inventory gaps expected to hit shelves by late June. Bessent claims that the surplus country always has more to lose, but that may not hold against new trade alignments forming across Asia. Vietnam, Malaysia, and India have all increased exports to China by over 20% since March. According to regional trade data, the bigger risk is the fragmentation of global supply chains, where the U.S. is no longer the central node. If the Swiss talks stall or fail entirely, uncertainty will shift from policy risk to real-world scarcity. The American pitch is clear. Scott Bessent is asking the world to bet on U.S. resilience. But behind the polished slogans lies an economy weighed down by $36.2 trillion in national debt, trade gridlock, rising import costs, and weakening investor confidence. The pitch is flawless. The delivery is professional. But the audience is changing. Global capital is watching the dollar slip, gold surge, and U.S. bond yields spike just to hold attention. The question isn't whether America will survive, it's whether its markets can thrive under these conditions. So now it's your move. Will global investors bite or will they walk away? Drop your thoughts in the comments. Because if this standoff drags on, we're not just facing a financial panic, we're witnessing a transformation of global capital itself. If you're following along, don't forget to like and subscribe, and check out another video we've prepared that dives even deeper into the latest market shifts.